everyone hear me well?
You're
Can you
a
hear me well?
little soft, Adam. I don't know if you can boost your mic a little bit.
Is it any better now? Is it still
Okay,
soft?
that does sound a bit better. Yes, if possible, just talk a little closer to your mic. A little soft still.
All right. Okay. Thanks, Raleigh, and welcome everyone. Again, as Raleigh said, my name is Adam Manning. I'm a CPA with Green NFH or Green Company. We are a certified public accounting firm that specializes in trader tax. I have our website up now that you can. I actually could post a link real quick in case you wanted to visit it while I'm talking about it quickly. Um, the website's basically here. It's got a copy of. There's a ton of educational stuff here on our website. So a lot of what I'm going to go through is on our website. It's just going to be me giving you an overview of what trader tax is, how it works, how it can save you money if you qualify, and what steps you can do once you qualify as a trader. At our website, you'll see there's an educational center. If you click on this, it'll take you to our Trader Tax Center, essentially, which will give you the overview of basically what I'm about to go over is the trader tax status, mark-to-market accounting once you qualify as a trader, how things are handled and taxed. Now, all this is just a quick overview on our website. These are also located in our 2014 Trader Tax Guide that we offer for sale at our website as well. You can purchase that here. The guide is for sale. It's going to go more in depth into everything I'm telling you about today. Plus, it has examples that you can purchase of tax returns showing you how they're filled out and what footnotes and everything we include with our tax returns. So I wanted to go over that first and tell you a little bit about who we are. The company is 30 years running now, strong, with Bob Green being the founder of the company that we work with, and Darren Neuschwander and I both are partners involved, and there's two other partners, Nathan Faircloth and Jamie Hardy, who we've recently joined Bob in the last 2 years to kind of expand this thing and continue being the leader in trader tax. You can learn about us at the website from some of our bios, but I want to show you the website, and now I'll just go into some of the presentation and get going with that. What we're going to talk about today mainly is the trader tax steps for traders of what we're looking at and how do we distinguish what's an active trader, who qualifies for trader status. So basically what we're going to talk about are who's an active trader and what can you do with it. Basically, if you're an active trader, you can claim trader status, which gives you the business treatment of your tax expenses. So if you have any expenses with trading, if you're not an active trader and you don't claim trader status, then you're technically an investor, and you can only deduct those on your Schedule A, which gets a 2% haircut off your adjusted gross income, and you can only take certain expenses. Whereas as a business, you can deduct these fully on a Schedule C. You can deduct more items such as home office and expenses for education and seminars, whereas you can't do those as an investor. Also, even if you qualified several years ago, you can go back to 10 still and possibly amend. If you had the trading level and you met all the golden rules and you qualified as a trader, it's still not too late to go back and amend and claim trader status. It's not an election. It's just something you qualify for or you don't. So you can't always go back and look. I got some question of what constitutes active trader status. We're going to go over that in a minute. It's going to be one of the first parts I get. When I get through this, we'll go through exactly what steps we go through as our golden rules for who qualifies or not. Also, we're going to touch on, during the discussion, entities for traders. Once you set up and you qualify as a trader, you may want to start trading in an entity, which can open doors to paying yourself a W-2 and contributing to a retirement account. And I'll go into the reasons why you have to have an entity to do that later. But entities can also help reduce some of the risk that you run into with the IRS. The most recent court cases coming down challenging any trader status with the IRS have all come from individual accounts, trading on the 1040, not an entity. So we find that the entities help almost shelter the trader status. So basically you trade in the entity issues a K1, you simply pick the K1 up on your individual return, so it doesn't draw as much risk as potentially a Schedule C could. We're going to go through, I see some questions about some multi-member LLCs. basically that's what we're going to talk about, some of those, what type of LLC or partnership is going to work. If you want to form an entity, what kind of entity works best for you. Problem is sometimes you can't, it's not one size fits all. You've got to figure out what's going to work for you. That's going to involve possibly having a consult or talking to a tax professional before you jump in and determine what you can do. Some states allow this, some states don't allow certain corporations and LLCs. There's add-on fees for some. So you almost need a consult with a tax professional beforehand. Don't go and open something and then learn the pitfalls of what you just did later. These things are not hard to open. They can be opened quickly in your home state. Oftentimes you find people that are looking to open, an entity in Nevada or some of these non-taxable states, but you've got to consult with your tax advisor, because if you're in your home state and trading in your home state, technically you would have to ultimately register there as a foreign taxpayer, and that basically eliminates the fact of even opening it in the other states. So you could cause more trouble than good. Um, these new entities can also do different things that you can't do as an individual later in the year, like such as making the mark-to-market election. That's something I'll hit on later, but things to keep in mind. Other items we'll discuss in a bit are the tax treatment. What are the key treatment differences between certain items: securities, options, stock options, exchange traded funds, the futures, forex, how all these are treated and taxed, and will they be taxed. The next things we'll look at are elections. Once you qualify as a trader, now what can I do? All right, I'm a trader, I can deduct my expenses. What can I do now to help even more? And there's certain elections that you can do that will help you be able to deduct more of your losses potentially by making the mark-to-market election, which we suggest often with security traders, and not so much with futures, because the future traders could be giving up a favorable 60-40 treatment, which is the 60-40 we'll talk about later, but essentially it's when you trade futures, 60% of the gain or loss is taxed at long-term rates, which are lower, and 40% at short-term rates. So you oftentimes don't want to give that up to get mark-to-market. Future traders can also make an election to carry back their future losses against older future losses, back to 3 years of future gains. So there's another election that's in place. Forex, there's a couple of elections you can make when you trade Forex. You can possibly elect to out of the ordinary gain and loss treatment of Forex and have it taxed like a futures, and you can also elect to have it the way you tax it. You can if you're a trader, you can have it on different forms than you can as an individual. I'm sorry, there's only one election there, really. So now we'll go through I saw a question earlier talking about what do you have to do to qualify as a trader. So here's what we'll go through is you got to determine, do you qualify as a trader? Because if you qualify as a trader, you get to take so many more expenses. You're going to save a ton by qualifying as a trader and deducting all of your expenses on Schedule C, as opposed to having to deduct some of your expenses as investment expenses on Schedule A. As a qualified active trader, you essentially can deduct your seminars, your educational things, home office. All these things are opened up for deductions that you can't take as an investment expense. And also, if you're deducting on the Schedule A as an investment expense, you're limited to 2% of your adjusted gross income. So if you've got $100,000 in adjusted gross income, your first $2,000 of expenses you can't take, and then you're getting limited elsewhere. So it's a huge benefit to have trader status and be able to deduct these as a Schedule C expense on your return. And also it's going to allow you to even maybe possibly look back and grab some expenses right before you started. These are called startup expenses. So it opens the door to greater deductions. Business traders need to meet all the below requirements to comfortably qualify as trader status. So here are what we call our golden rules. If you're at our website and you went to the educational center where I was, you'll see the same list that I'm about to go through. So these are kind of the steps we look at. If you come to us and you want your tax return prepared as a trader, we try to go through these steps to determine if you qualify. First thing we look at is Is it being treated like a job? Do you do this full time? Or possibly part-time? We see sometimes some West Coast traders that can do it early in the morning before they go to work, or if you're trading Forex, you can possibly still get by with having another job. But we ultimately look for it to be something you're trying to do and make a living from. We also look at the frequency of trades being made, that you're making trades on more than 80% of the available trading days in a consistent, frequent manner. This was the biggest thing that brought one of the recent court cases down. Holsinger, he lost his case because he only traded on 45% of the days traded. So clearly was not trading and treating this like a full-time job with no intent of it. Also, the hours, we try to look and see if you meet some. It's almost like if you meet this, you're going to meet most of them anyway. If you're actively trading daily, you're going to have the hours in it, the research in it. You're going to get the hours probably. You're probably going to get the trades. If you're trading daily, you're going to get over this hump of 500 or more round-trip trades a year. This one's probably the easiest one for the IRS to look at because they can clearly see how many trades you made. They get, if you're trading securities, they can see the number of round-trip trades being reported to them by the 1099. So they can determine, if there's only 100 trades, they can clearly see that you didn't have enough activity going on. They want to, and when we look at all this activity, we're looking only in the taxable account. We often have clients that consult with us that trade retirement accounts, and they have a ton of trading in their retirement account and maybe a couple hundred trades in their taxable account. Well, we can only look at the trading account. We can't look at the trading taxable account. We can't look at your retirement account that you're trading on the side. So it's only related to the trading account to determine trading status. And we're also going to look at how many days you held your trades. Were they, mostly 1 or 2 days, or maybe some swing trades here and there. Maybe you held some positions a couple weeks because of, the option strategy or something. But mainly looking for short-term holdings. We're not looking for 6 months, 7 months, longer than, we're not looking for anything really long-term investment positions. Those need to be kept segregated, possibly in a separate account if possible. IRS also looks for intention, looking for your intent to run a business with this, that you're trying to make a formal go at it and keeping up with your records and your planning. They want to see that you've got the resources. For our CPA firm, we got to have computers and software and monitors and chairs and desks, which I'm sure all of you have. So they're looking for all this, the home office, making sure that you're basically saying, this is my business and I'm doing this as a legit go. The account size will come into play also, and normally see this with limiting factor when you have some of the smaller accounts, especially like in this slide, you'll see the mini Forex account of $5,000 is probably a bit too low to go to the IRS and say that this is my full go at trying to make a business run. They may say that's a bit low to qualify. So if you met all those steps that I just went through, you basically have opened the door to other benefits, I guess, so to speak. So you qualify as a trader. So now what can I do? All right, so I qualify as a trader. I now can make what's called a mark-to-market election. This is something we recommend for people who trade securities. You can make a mark-to-market election. You do this by April 15th of the year you want it. So if you wanted it for 14, if you didn't do it by April 15th with your extension or return, you kind of missed the boat on that. So you'll have to wait to next year, or you could possibly open an entity and elect mark-to-market in it within 75 days. So by doing the MTM election, what it allows you to do is you report the unrealized gain and losses every year. So at the end of the year, any positions you have open in your trading account, you look at the unrealized gain and loss and you recognize it. You take the cost you paid and you look at the market value at year end. The difference is what you pick up as gain or loss. The market value becomes your new cost basis for next year when you sell it. So you basically get to realize any unrealized gain and losses. These are also taxed as ordinary gain and losses. We call the 475F MTM election kind of tax loss insurance, and I'll go through that in the next slide of what I mean by that. One of the huge benefits of 475F is, of course, the ordinary gain and loss treatment, and also the fact that it gets you out of wash sales and capital loss limitations that you have as a cash basis trader. With a cash basis trader, you're limited to those puny $3,000 a year capital losses. You don't really get to take much. You can lose 100,000, you can only take 3,000, and 97,000 is carrying over until you use it up. So with 475F, you lose 100,000, boom, you take $100,000 on your return to offset other income or possibly carry back as an NOL. Also gets you out of the wash sale and straddle loss deferral rules, which are becoming a huge headache with all these brokerage accounts. So it's a great election to put in place to avoid all that and help keep accounting much easier on your accountant and yourself to see how much you've actually made or lost during the year. The difference between capital gain and ordinary gain, as far as they're both short term if you're trading. So the tax rate on both of those is exactly the same. There's no difference between a capital gain short term and an ordinary gain. The difference comes into play is when you have a loss. Capital losses, like we just said, $3,000 a year, you don't get to take them. So with the ordinary loss, of course, if you take too much, you end up losing 100 grand. You can take that $100,000 and carry it back and get potentially a large refund. Or if you lose more than that, you can still carry it back to 2 years and amend those returns and get a refund. The 475F is something we recommend mark-to-market for our securities traders, not so much for our futures, only because of the fact that the futures, if you do the mark-to-market, you're going to give up the lower 60/40 tax rate treatment on these, which is the 60% tax at long-term rates. The max rate of that would be 20% this year, and 40% is taxed at your short-term tax rate. So you get a nice benefit of lower tax rates on gains when you trade futures. So it's hard to say go do MTM because you could lose out on that if you had gains. You could benefit from futures making the MTM election, and the only time I really see this come into play is if someone comes to me and has an account with probably with a large amount of losses by March or early April. Then we'll possibly look at, hey, maybe we should file the MTM election right here in April, lock in this ordinary loss. That way you can go ahead and take it. But otherwise, it's normally do not do it because the futures, you don't want to give up the 60/40. Plus, you still have the option to elect to carry these things back. You can carry these future losses back 3 years, but you have to have future gains. So a lot of things come into play and things we need to keep up with. Another warning that we warn people about is the capital loss carryovers. This is something that really bogs traders down. You got to watch that. You can't always just say make the mark-to-market election. If you have capital loss carryovers, you need to make sure that you can try to use those up. If clients come to us all the time with large capital losses and then they want to make the MTM election, so we caution them. We almost need to wait and see how you do the first 3 months of this year. So before we make this election, possibly to see if we can use up. If you generate capital gains, we want to be able to use those capital gains to offset these capital losses. So of course, the flip side of that is we get into the next part of the year in March, and they've got huge losses again. We don't want to tack on to these capital losses, so we didn't make the MTM election. So kind of a touch and go situation when you get into the capital loss carryovers. If you have them, we have to watch the account through the first part of the year to determine whether or not you want to make the election or not. If you want to make the election, there's 3 steps involved. You're basically going to make the election by April 15th of the year you want it. You're going to want to file that tax return. For example, you'd want to make it by April 15th of 15, then you want to file your 2015 return using mark-to-market and reporting your gain and loss correctly. And then you're also going to file a Form 3115, which is a change in accounting method. You're going to want to file that with the actual return for 2015. If you miss one of these steps, you could jeopardize the MTM election, and the IRS could come back and say that you didn't do it correctly and not allow you to use the mark-to-market election. So I said the first step, basically by April 15th, you file the MTM election. You can do this with your extension or your return if you file your return by April 15th or before April 15th, whenever. You just need to make a one-page election to make this. So the example down here is, if you want it by April 15th, you need to file it for 15. So The second step would be file the return using the mark-to-market, which is simply just calculating your gain and loss and putting it on 47.97, and then um, reporting your gain and loss using mark-to-market. And then the third step is to file the 3115. This is another form that can often be messed up, and you really want to, if you have a year where you file mark-to-market, you're definitely going to get a CPA involved to help you at least get that year done and get this 3115 filed correctly and what's called the 481 adjustment done correctly, which is the 481 adjustment is basically truing up your account to mark-to-market the first year you do it. So this is something you want to look at. This 3115 is filed with our IRS national office, so you need to get that done by the due date of your return for that year. So you've got MTM, you've got trader status, you got MTM. What happens if you have a big loss? I talked about it earlier. Net operating losses come into play. What you can do with these net operating losses is carry them back 2 years. Basically, in my example, let's say you lost $100,000 and you had no other taxable income. So now you've got a net operating loss of $100,000, and you can take that back 2 years to offset income from the last 2 year returns and get a refund. So that's a really big benefit of MTM, is being able, if you have a bad year, you may be able to go back and recoup some of the taxes you paid in the last 2 years. Maybe you had a really good year the year before or the year before that. It really gives you a situation to go back and take care and get those refunds. Like I said, they're carried back 2 years unless you have the option to carry them back 2 years, or you can carry them forward. That all becomes a planning idea, I guess, so to speak, when you're sitting there working on the return. When we do one, we talk to the taxpayer. We say, hey, you got a loss. Do you want to carry it back? Also comes into play is how good is this trader status right now? Was it close? Did you meet all those golden rules and blow them out of the water, or did you barely make the golden rules? If you barely made it in what we call a close call, then sometimes we just choose to maybe forego the carryback and just carry that in on forward. Basically what that does is it means you start the next year out with a negative 100,000 in this example. So by doing that, it doesn't draw as much attention possibly to the return, is the reason why we sometimes carry them forward instead of back if it's close call. So it's easier, it's better not to draw attention and then have that going forward. The next thing we talked about was what I was talking about earlier, is the capital loss carryovers and not getting caught with these things and having those carry over and over and over. We get this every year in December. I do consults all the time with people with these capital loss carryovers, and we have to determine how can we use these things up. Our ultimate strategy and the perfect example I can give you, and the best way to do it, is if you have them and you can somehow generate gains early in the first part of, let's say you go through 14, you end with capital losses, and you've got $50,000 in capital loss carryover. You get into early 15, and you're up 50 or 60 grand in your account, and you haven't made the MTM election. So we would basically say, don't do the MTM election, stop trading this account, form an entity. We're going to use these as your capital gains. They're going to offset all these capital losses, so we can eat all those up. We'll start you in a new entity. In the entity, we'll go ahead and make the mark-to-market election. You'll start trading in it. It'll have MTM. Now you've got the tax loss insurance. You've used up your capital gain, and that's the perfect storm right there. If we could get that to happen, then you're great. Problem is, sometimes it doesn't happen, and you end up with losses early in the year, and we have to decide how much of a loss tolerance do you want to add to these capital losses, or do you want to make the mark-to-market election and go ahead and lock them in as ordinary, and we'll determine a different way to use up the capital loss carryovers. Forex traders don't have to worry about the capital losses much. They basically start with ordinary gain and loss treatment, so that's a huge benefit for Forex traders, especially someone getting in that may lose some money. You get ordinary gain and loss treatment on it, so that's better than trading stocks and losing money right off the bat when you're trying to learn, because you're going to be able to get full benefit for those losses against other income, assuming you have other income. The only potential problem with it is if you don't qualify as a trader, the Forex losses technically don't create that NOL I just talked about. They kind of just go away. If you are a trader, then they are what's considered a net operating loss because you're in the operating business of trading, so you can use them to carry them back. So that's the only potential downfall you may have. But if you had other, let's say you had a or your wife or someone had a $50,000 W-2 and you had $10,000 in Forex losses, as long as you have income to offset them, you're fine. You won't lose them if you're not a trader. But if you didn't have any other income, then of course, yeah, those losses would just ultimately be lost. So in that situation, we may would tell traders to do what's called the opt-out election for 988. You basically opt out and say, I don't want to use the ordinary gain and loss treatment. I want to treat these Forex as futures are treated. And then the loss would potentially become a capital gain or loss. When do we assess trader status? This is simply just going over what I just said. You're basically going to have to look at it year end. You got to look at it and see how you did. You can look at it throughout the year. You're going to have an idea if you qualify or not. But we'll look at it after year end, tally up all the time you spent, the trades, if you put the time in, the traded on the available days. Then we're also going to see if you qualify the trader, did you have an entity? If not, then we got to determine, then your Schedule C, and we'll just simply report it on your 1040. It's going to open the door to the home office, as I said, and then depreciation. Both of those are technically different forms, but then it all flows to the Schedule C and gets captured there for your trading business. Futures trading gain and losses. We're going to go over here, I guess, how things are reported. Basically, the trading expenses, you're basically going to report those on Schedule C as a trader. Trading gain and losses are kind of going to get reported the same as they would as an investor. Even though you're a trader, they go to their own forms just like they normally do. The only one different would be is, of course, if you're a trader, you can have MTM, so that's going to go to a different one. So futures are going to go exactly where they would if you're an investor. They're going to go to 6781. They're going to get the 60/40 treatment. It's going to flow to your Schedule D. Security trading is going to go to 8949 and then flow to Schedule D. If you elected 475 MTM, then it's going to go to what's called the 4797, and it's going to go to the bottom of it, Part 2, and then flow to page 1 of your 1040. Forex is either going to be line 21, other income if you're an investor, or it's going to be the 4797 if you're trader in Forex. If you make the election out and treat it as a future, of course, it's going to go on the 6781 just like the futures. The problem with it here is your expenses. Let's say you had $20,000 in expenses somehow. Those all go on Schedule C, so the front page of your individual return has got a negative $20,000 sitting there for the expenses. You could have huge gains in trading, but they're not going to be on the Schedule C. They're going to be on their own form and then ultimately either flow to Schedule D or 4797. So basically the IRS is going to get this huge red flag of, we've got these ginormous loss sitting on page 1 of the Schedule C, what's going on here, and it's going to be a red flag for them to possibly come and look at your return. So our solution that we try to do is we try to tie the trading business and the expense together, the trading gain and losses. So if you've got 89.49 gains from trading securities or 47.97 gains, what we do is we do a transfer. Basically, we'll transfer some of it off of that 47.97 and we'll transfer it to the Schedule C. What this will do is we ultimately just zero out the Schedule C so it doesn't even show up on page 1 of the 1040, and it also allows us to free up the home office and possibly Section 179. It's a huge benefit to do this, to take that big negative red flag off the front. We free up more home office deductions. We do this only to zero it out. We never transfer more because that could ultimately raise the eye. The IRS could question whether or not there's some self-employment tax needs to be imposed, which it shouldn't. Normally traders don't owe self-employment tax. So we do this to zero it out, to be sure we ultimately get the best benefit for our home office and the best benefit for any Section 179 expense we want to claim on assets purchased. We also attach, when we do this, it's nothing in the IRS code. This is something we do, and we document it well in our trading footnotes. Every tax return we file with a trader has over 3 pages worth of tax footnotes at the back of the return that we send to the IRS, basically explaining why the taxpayer qualifies for trader status, what is trader status. We refresh the IRS on what it is, why they qualify, why we're filing it on the forms we are, and what we're filing. And then we also, if we do the transfer strategy, we have a footnote explaining hey, we're transferring this. It has no effect on the overall tax on the return. So we document everything well and try to explain ourselves to the IRS before the IRS has to send a notice to make us explain it, I guess, so to speak. So how do you account for this trading? So we know where trading goes, but how do I keep up with it, and how do I know what to put where? The futures is the simplest of them all. I love it when people trade futures because it's basically just a 1099B that I get. I can simply pick the number right off there. It's one number. It's summary reporting. You put that one number in the 6781. That's it. You're done. Futures is super easy. Forex is about the same. It's summary reporting. There's no 1099 involved in Forex though. You just have to get some type of annual statement that's going to show what the overall gain and loss was for the year. Next one would be securities, which is the most complex of them all these days, with the 1099Bs just growing to these huge proportions of the. In 11, the IRS imposed that by 12, the brokers need to start reporting cost basis along with the proceeds. In the past, brokers only had to put the proceeds on. So now they're issuing these 1099s with the proceeds and some cost basis, but they don't cover everything. It's only on the covered securities. So you get a 1099, you can't use that to simply prepare the return. They don't put options on there. They don't show the sales of some options. Some options they do. Sometimes they don't show the cost basis to them. There's non-covered securities that they won't show the cost basis. So it's a huge problem. You almost have to have some type of third-party software to help you produce the line-by-line accounting that you need to attach to the return to support your trading. So to simplify it, as I said, there are some third-party softwares out there that allow you to either download and run reports. There may be softwares built into your broker that you're using. Now, these all are so tough. You've got to find a software that can handle it. Some of these other softwares are not going to be handled. You got to find a trade accounting program that you can download into, match up your accounts, calculate wash sales if you need them, do mark to market if you need it. They need to be able to then produce some report that you can attach to your return. The futures are super easy. Like I said, you get the 1099, they get the 1256 treatment, which is the 60/40 rate, 60% capital gain rate. So your upwards of that is 20%. So no matter, I mean, they're all short-term trades, but you get the benefit of 60% going to the long-term rate. That's a huge benefit. When we talk of the 1256 contracts or the futures or commodities, these are some of the lists of what we're talking about. Again, all this stuff is at our website. These are just a quick slide to go over, I guess, what we're talking about. We're talking about the commodities and futures and foreign futures. That have approval letters. These are automatically marked to market every day, so there's no rules to do. You just report them off the 1099. The securities we're looking at, these include stocks, equity options, mutual funds, bonds, ETFs that are based on stocks. We're also these ETFs that are normally treated as securities when they're based on securities, and if they're based on commodities and futures, we treat these ETFs and options on as a future contract. Gold ETFs, as you can see here, some of these are going to be taxed at a different rate, which is called the collectibles or precious metal tax rate of 28%. Again, I'm not going to go too far into this, just giving you a brief overview. Forex, when I speak of Forex, we're talking spots and forwards and OTC, over-the-counter option contracts. We're looking at how they settle and which ones can qualify for the election out. You're not going to be able to use when I spoke earlier of the 60/40 treatment for Forex, that's not something that's going to be available for these OTC options. Some of those are barred from the Section 1256 treatment, but most of the others, as you can see, you can make that election out. It's simply an internal election that you do. We normally tell people to, at the beginning of the year, if they want to elect out of 988, to simply just forward an email expressing what they want to do to themselves, so they have something that's time, date stamped of the election, because it's simply an internal election, nothing to file with the IRS. These are just a little overview of Forex rules. The rules are often vague on this, and there's tons of information on our website on keeping on how these are taxed and how they're handled. Again, there's no 1099s reported on Forex. You simply have to just run an annual report from your broker and report these yourself. The reporting duty is on you for the Forex. Last thing I think we'll go over here is some of the entities that we look at and can use. We recommend these for traders, not for the main purpose of that a normal person would have an entity. Usually you want an entity for liability protection, but normally you don't need that as a trader. You're not really looking for liability protection. It's your own money that you're handling. Now, if you're a money manager, you may need it, or investment management businesses have to have an entity, but it's not something you need just to be a trader. You don't need a separate entity yourself. You can file on Schedule C, but when you do decide you want an entity, you're going to have to determine what works best for you. Like I said earlier, one side's not going to fit all. You've got to determine if a general partnership is best for you, a single member LLC that doesn't have selection, what's going to work best for you, what works best in your state. You got to determine that. You got to think far ahead of this, how it's going to be taxed in your state, what fees are going to be involved, and ultimately, is it worth it? You got to kind of weigh those risks and rewards and pros and cons of each entity, and you need to discuss that before you go out and just set something up. So most traders don't have earned income. Trading in itself, the gain and loss from trading is not subject to self-employment tax. Some of you may not know what self-employment tax is. That's the FICA and Medicare you see on your return. So if it's not subject to self-employment tax, then you can't do things that require self-employed income, earned income, so to speak, which would mean contributing to a retirement plan or deducting some health insurance. Things like that are not open for individuals that trade unless you find a way to manufacture some income. So we have different entities and retirement plans and structures we can set up that would help you obtain your goal, so to speak. Right now we're looking at S-Corps and partnerships and which one would be best for you. Right now the S-Corp's the best. You pay yourself a wage, you set up a mini 401k plan in there. Basically you can put 17.5 as your employee deferral, and then you can match that, and you can ultimately max out that thing with 52,000. So you can pay yourself a W-2 out. It becomes an expense on the S-Corp side. You just pick it up as a W-2 income on your individual return. You put your retirement plan in there. You pay your health insurance in there. That's the planning we can help you do, or any CPA could help you do, but you've got to contact them before you're in and make sure you get your ducks in a row, or even contact them now to determine what I need to set up, what entity works best, how do I get payroll going, how do I get the mini 401k set up. Again, these 401k plans, they have to be set up before you're in. So if it's something you're looking for, if you've been profitable this year, you forming it, or you want to form an entity and try to get some profits before you're in and do this situation, it's something you got to do before you're in. You can't wait and contact someone later and get it set up. So you've got to have the generated income to pay yourself, and then set up a 401k plan and be able to contribute to it. This slide is just simply going over what I said earlier. Is online traders are usually exempt from SE taxes. There's normally only two that are subject to it, and that would be someone that's on the exchange, the futures exchange, and then also some prop traders. They'll get a 1099 miscellaneous and have a box 7 in there. So there's only really two situations where you'll see people with self-employed income from trading. So kind of wrapping this up, this says year-end tax planning, but it's more of mid-year. Think about year-end. You want to look at, when you're getting close to year-end, you've got to determine what's it look like. Am I going to qualify as a trader? Maybe I need a consult. Maybe I need to find out if I'm going to qualify. If I do, maybe I need to go ahead and buy that new computer or buy a new office desk I've been needing to get. I can accelerate some of these expenses right at the end of the year and deduct those on my return. So it's something you need to look at right at year-end to see if you qualify. On the flip side, if you're seeing you don't qualify, but you know you're going to start trading more next year, then maybe you want to defer some of those purchases and look until 2015 and push them into 15, and then you can deduct them there. You can always, look back we tend to look back 6 months on startup costs, so you can look back and grab some of those costs just before you start trading. So all things to keep in mind as the year starts wrapping down in November and December to see where you are and determine can I move some expenses up to either increase my refund or decrease my tax liability. If you don't have MTM at year end, you may want to look at some different strategies we've looked at before of, do I have some wash sales sitting around that are going to be there? So if you have these wash sales that are going to be sitting there at the end of the year, you can make the MTM election. And what these wash sales can do is they can ultimately be converted in 15 to ordinary gain and losses via that 481 adjustment. So all things to think about going into the end of the year and determine whether or not trader status is right for you. So with that, I've kind of wrapped up. I see some questions, so I'll try to go through and answer a few of these if I can. Let me read through a few of these. Someone asked, does this work for futures trading? I think we went through that. Yes, of course, you can be a trader in futures as well as stocks or anything. Today I had a trader client. Okay. Some of these are asked for recommendations on other things. Let's see. This question says, if you have a W-2 wages from a full-time job, will you automatically not qualify as a trader even if the activity might typically meet requirements? No, that's where we go into the part-time. It depends on what your job does. I mean, we've had people with full-time jobs, but they may be on up in their job, and their role in the company is they may be possibly able to trade during the day, and their company may know about it, or you may have the hours and everything that you put into it and still able to make the trades depending on what you trade and where you live. The answer is no. It doesn't automatically disqualify you. It makes it a little tougher, and it's also a situation where you may want to look at an entity to help shelter it away from the fact that you got a W-2 sitting there. Someone asked for entity. Someone said daily from 1 to how low of an account size would qualify. That's all kind of relative. If you go back to the slide that I had on that, I believe the 25,000 is what some say is the pattern day trader. That would be ultimately an area, but I wouldn't say that if you fell below that, you don't qualify anymore. You can easily have more than that in there and lose a ton of it. I'm not going to say just because you fell below it, you don't qualify as a trader. So it would be a situational thing where we'd have to have a consult and see how strong are you on all the other things. Is it all you're doing? Then possibly, we don't put weight on one more than the other. They're all pieces that go together, and if you fall lower on one, we kind of look at the others and see if it's strong enough there. And if it's a close call, what we do sometimes is, if you feel you're a trader and you want to file as a trader, and we feel that you're only short on one or maybe two of them, then we'll write a letter stating what we've expressed it to you, that we think you may be short on this, and we'll sometimes have you write off on maybe you want to take the stance that you are a trader. So we'll have you call what's called, we'll get you to sign a letter saying that you understand the consequences involved. So we're not going to ultimately rule you out just because of that. Can capital losses from 10 years ago be used today? Yes, capital loss carryovers carry forward until your death. So as long as they're yours, they're going to carry forward until you use them up. So you can use capital loss carryovers 10 years. Now, the net operating loss I spoke of earlier can only be carried forward 20 years. How long in the future can losses be carried forward? Basically, it's indefinitely, depending on the type they are. The capital losses indefinitely until your death, and then the future, or the NOL, 20 years. How does the U.S. government treat foreign investors? Depends on your status. I'd have to know more of that. That'd have to be a consult to answer what's going on there and what you're trading. what if you trade a combination of futures and we have people who trade stocks, futures, options, forex, the whole gamut. So there's no difference between what you trade. You just have to account for it everywhere. You may have a 6781 for futures, a 4797 for forex, and 8949 if you didn't make the MTM election for securities and options. You may have all those forms with trading activity on it, and you'll have a Schedule C with your expenses, and it'll say at the top of it the description for your Schedule C is going to be trader and securities, commodities, and forex. So, or currencies. You'll have all that. So if you've got all that, that's what it'll show. Do you have to have the account names in the business? Yes. If you form an LLC or a partnership or an S corp, you're going to have to have the account set up in the name of that and trade. It's its own self. It's an entity of itself. So you have to have the account set up and the trading activity, and the entity has to qualify as a trader itself. So you have to have that all set up in its own name and its own EIN number and trading itself, and it has to qualify as a trader to get trader status and be able to deduct the expenses as ordinary expenses and do the MTM election, all that. So basically the account, once you set the entity up, it's its own being, and it has to qualify and stand on its own as a trader. Well, the qualifications to form an LLC, I don't know if there's qualifications. You just would have to form it. It would depend on where you're at. If you're out of the country, that would be a question for a consult almost. Yes, Randall has a good point that some of the brokers and a lot of them are charging a bit higher commissions and things for the businesses. Some aren't, some are. It would depend on how it's set up. I would defer that to Bob. Bob Green is the one who handles all our entity consults, and he would definitely know which ones do more than the others. He handles that on a day-to-day basis as far as setting up the entities, and basically Bob can have the consult with you. We can pass it on to some attorneys that can basically set these things up, and we can get it turned around pretty quick if you ever want to have an entity formed at a really good rate. You can go to our website and read more about the offerings that we have when it comes to the status of setting an entity up. I'll show our store real quick before we leave. So if you wanted to sign up for any consults, or if you wanted to look at buying the tax guides, you can simply go to the website, go to the store. If you want to go to possibly shop and see what our offerings are, we give you an offering of what's involved. We have tax preparation, we do consulting, we do entities, we do accounting and software, IRS representations, we do some investment management. So all these are offerings that we offer. If you're in tax compliance, you may fall under an investor and non-trader, or you may actively be trading already. So we'll go through some steps of basically what this entails and what you have if you're a trader. So you want to go to look at our consults, you can have a consult sign up now. You can have one with Bob, or you can do an entity consult, or you can just do a consult with us if you want to do some tax planning or just talk to us about your situation. Or we often review returns for people. We can do consults and see about it, and if you've already filed, we can do that as well. So if you have any questions. I don't see any more questions.
Hey Adam, it's Raleigh here. I had a couple that I had just jotted down. Wanted to make sure that we covered those. I noticed that there were several folks here that are outside of the United States, and I guess the straightforward question is:
we do.
Is
We
your
have
representation
CPA
just based on U.S. traders, or do you work with international traders as well?
We leave her to the international stuff, so she handles all that. So yeah, it's nothing that we can't handle. We do a good bit of international work actually. So if there's people here that need this. Yeah.
Okay, so that's excellent. So you're international and global in scope. Another quick question. I noticed that there is a rise in the increase on trading binary options through the Nadex exchange.
You have to look at the
Is there
blogs on
anything
that.
unique or
It's something
particular
we're still
about
going over right
Nadex
now.
as it
Darren and I
relates to
were
tax
discussing
accounting
it
treatment?
just last week. Me, Bob, and Darren, and one of our tax attorneys were discussing that. Right now, it's being taxed.
Okay.
They're taxing it and reporting it as if it's a future. Our stance is we're not really sure if it should be treated that way or not. So we're still looking on that. But you know, they're set up under the exchange, so they're reporting it just like other things under that exchange. So we're not quite sure on that yet. We're staying on that. We're working on it as we speak, actually.
Okay. And I tell you what, that kind of brings me to a kind of a closing point that I'd like to make for everybody in the room here, and also to thank Adam for this highly informative presentation. Trading is as a business, and it's important that you have a team. And I believe that, that team definitely needs to include not only your broker, but your tax accountant and whoever your trading mentor is. And when it comes to tax accounting, what I found personally as a retail trader is that the IRS rules around tax treatment can be fairly nebulous, and not every CPA has the training and the background to experience to properly apply the rules in your favor and to make sure that you're in compliance, because once again, there appears to be a fair amount of gray area there. Now, I don't want to put words in your mouth, Adam, but that's clearly my takeaway. And I have certainly benefited from taking advantage of the services that are been offered by Green and Company. So once again, thank you so much for coming today and to being a part of our trade-a-thon here. There's a couple of other quick questions that have come up here. And one thing I would say is this, folks, there's about 6 months left in the trading year. So if you have any thoughts or questions around whether or not you need to potentially form an entity or do something or make a move or do some prudent planning around your business, I highly recommend that you have a 30-minute consult. It really, what Bob Green will share with you in 30 minutes has the potential to save you or make you a significant
blog that Bob put up regarding the binary options. So anyone go to our website and click on blog up there. It's the latest blog. We just released it June 20th. So that's some of the writings we have on it. So it's a good bit. It's a long blog, so we put some time and effort into it. So
which tells me that the direction is fairly nebulous. This is not a straightforward yes or no. This is not a binary option answer for a binary option.
Taxes. Yes, we can do Canadian. Like I said, we have people here, a CPA that does all our international work. And I still write off education conferences for the year, even if it was before setting up a corporate. It depends on whether or not you qualify. You got to be the trader first before you can write off the education conferences. So it would all depend on whether or not you qualify as a trader, and then we can possibly, look back and determine how far back those conferences and education took place. What is the ration of the profit? Not sure. Maybe that is it 64 to 4? It depends on how it's taxed on Forex. You'll just have to calculate your gain and loss. We normally do what's called a performance method. I basically look at what you had at the beginning of the year or the end of last year, and then I look at withdrawals and contributions to the account during the year, and then I look at the ending balance, and then what's left, what the change is besides that, what's your gain and loss. And it's either ordinary if you don't elect 60/40, or it's 60/40 if you elect it out of 988. What is the ratio? So let's see. For E-minis taxes, I need software for my trades. I'd have to get. I'm not sure on that. Okay, sure. Yes, you have to elect. if you elect out of the 980 ordinary gain and loss treatment, yes, it would be the 60/40 4x treatment. So if you're profitable in 4x, then you probably want to elect out. That way you can get the 60/40 favorable treatment on that. Again, quick refresher, just go to the website. If you have any more questions, you can quickly go back to the home page here. This Trader Tax Center is exactly the stuff I just went over. There's a ton of reading here. If you go through this, you can read through the golden rules that I went through again. It'll take you on how things are taxed. And if you want to get even more in depth, and these are the chapters and just nothing but highlights. These are the highlights of what's in this detailed book that you can order. Definitely go to the store and order this book. It's the detail of all of those chapters. You can order just the book, or you can order a package that has some examples. I personally do these examples every year. There's several examples we go through. I basically just do mock-up returns in our software in different situations to show you how it's all should look when you get done with it. And I do notes to it of showing you, here's the example here. You know, Joe Blow was a trader in securities, elected mark to market. Here's how it was treated on his return. Here's the footnotes we put with the return. It has it all in there. So it's a great buy if you're going to try to do it yourself. I wouldn't go at it if I was going to claim trader status without buying this and at least understanding how it should look when I get done to make sure that the IRS doesn't come knocking at your door. So, Raleigh, I guess I'll turn it over to you guys. I'm done with my presentation.
All right, buddy. Well, once again, Adam, thank you so much for your time today and for, once again, that highly informative